podcast, everybody. Thank you for joining me. Appreciate it. We're going to get right into it here. We got about 15 minutes before the market closes, and you'll notice the S&P 500 is down on the day, roughly about 1.5%. You're seeing the Dow Jones down about 265 points, about 1.5%. The NASDAQ down almost 100 points, still above 5,000, but it's down almost 2%. And you're seeing utilities go down. You're seeing the international holding up. And so we're going to get into why in just a minute. And we'll come back to this S&P chart, but let's take a look first at the U.S. dollar. And we'll do that through the ETF UUP, which is the surrogate for that if you want to trade the dollar. Now, here's the deal with the dollar. Dollar today is down over 2%. It's only been down over 2% going way back, maybe 20 times for 20 times that's happened over several decades. So very rare that it would go down that much. And the main reason it is because Draghi and the continuation of, you know, the QE and doing everything they're doing over there. So you would think, well, shouldn't that be going down and the dollar going up? Well, keep in mind, I got to give props to my one of my traders, Casey Keller, who came up with this and reminded us of this, that, you know, this could be a buy the rumor, sell the news issue, in that, you know, all of this run that we've been going through has been because of that, because of the announcement that we knew would come. They're going to have to continue to stimulate over there across the pond, while here we're threatening to raise interest rates. So shouldn't the dollar be going up? Yes, and that's why it has gone up. If you go back to the beginning of 2015, you know, the dollar's up somewhere around, let's call it from last November to currently, you know, we're up about 11%, which is a big move in the dollar, in a currency. And so this is a classic buy the rumor, sell the news, I believe. And so we got the news that everybody was awaiting, and yet you're seeing this sell off. So UUP, if you own UUP, you're losing money today, and UDN is the bearish dollar. It's actually up about 2.5%. But here's the thing with this. So what are the repercussions of this? I think partially why the stock market is selling off, and you can see here what it looks like in the big picture. This is the last 2 days. Why it's selling off today is because a lot of people have been putting on this trade where they are long the stock market, meaning they own it, and then the funds they're using to fund that are yen and euros. So they're selling short yen and euros, and they're using that money to buy the S&P. That's been a great trade. Well, if the yen and euro are going opposite direction now than everybody thought they would, which if you take a look at the euro through FXE, you can see that the euro had been going down. It's up 3% today. So that's going against them. So they have to unwind that trade. What do they unwind? The S&P 500. And this is the S&P 500. So that's why it's going down. So that's a big reason. It's kind of forced selling. So you're seeing the dollar yen get reversed. You're seeing the dollar euro get reversed. So it's this unwinding, and I think partially you're also just seeing some dislocation. In other words, when some trend changes like that, which that's a big move, there's a dislocation, and you see people kind of panic and move. So that's why we're seeing the weakness today. Now, the beneficiaries of that should be oil, and you can see USO, and that is the case. We did get some chatter from OPEC saying, yeah, we might cut production, but we would like to see everybody else, non-OPEC members, do the same. Just jawboning. But basically, oil was already up on the market when that happened. It was as high as 4% today, but it should be going up because of the weakness in the dollar. In addition to that, you're seeing gold go up as well, about 1%. Now, we put a blog article out, I don't know, a couple of weeks ago, discussing the fact that in our aggressive strategy, we went long the gold miners, the gold mining stocks. And the reason we did is because of this pattern right here. If you take a look at this, we are believers, and maybe we're wrong about this, but we're believers that gold will eventually break $1,000 an ounce. Now, this is GLD. That's why it shows 101. But we think eventually gold will break $1,000 an ounce long term. But in the short term, we thought gold was oversold. And you can see we kind of believe that gold could make a run back up to these highs. The miners, that's an 18-19% move back up there, which would be a heck of a trade. So we're watching that. We're owning that. We own a portion in our aggressive strategy of that. And then we would use somewhere beneath here to maybe put a stop on it and get out of that trade. So it is a trade, more upside to downside. So, and again, that's why it's important about time frames, because many people would go, well, I thought you've been bearish on gold. We have been bearish on gold and think longer term it could go down, and I wouldn't even mind taking the other side of that trade if it goes up to short it. But right now, gold's so beaten up, it's so out of favor, and also the gold mining stocks have been holding up much better than gold itself. And when you've seen that in the past, that typically has led to more gains for the stocks themselves. So we like this trade right now. We own the GDX, which is the gold miners. There's also GDXJ, which is the junior miners, a little more risk in that. And then, of course, you could buy GLD, which is gold itself. But we like GDX for this particular trade. So we would like to see this thing, it's kind of, if you take a look at it here, you'll notice it's kind of been in this little box while it's been trying to bottom. And we're saying, hey, it's at the bottom of the box. Let's see if it goes to the top of the box. And if it breaks down, yeah, then we would probably get that stopped out. So that is benefiting today. That's one thing up in this bad market. But really, there's not anything outstanding happening in terms of, well, this is holding up better than that. The only thing that is holding up is emerging markets are down 0.5%, so about a third of the market drop, the S&P drop. EFA, which is larger developed countries. So again, it makes sense because of the dollar. It all has to do with the dollar. If the dollar goes one direction, a bunch of stuff's going to go the other direction, and that's what we're seeing. So that's happened at the same time. And again, it looks like our Fed may raise rates. I'll believe it when I see it, but that's what the market's suggesting by having this 70% odds of it being raised if you look at the futures markets. So we're also getting this higher rates today. So 10-year Treasury is up to 2.3%. You can see it's pretty big move. It's kind of been going back and forth here, but definitely working its way higher, especially from February of this year when we got down to 1.6%. So you may go, well, 1.6 to 2.3 doesn't seem like a big deal. Well, it is in percentage terms if you've owned something like TLT, which TLT back in February was $138 a share, and it's now down around $119. That is a 14% loss. Okay, so it has been a big deal if you've owned bonds. It hasn't been a good year for bonds, and it hasn't been a good year for stocks either. I mean, it really hasn't been a good year for just about anything. Even utility stocks are down 10%. Gold's down 11%. You got the commodity basket itself, which this is DJP. You can see this. This is just ugly, isn't it? And again, all this has to do with the dollar. So this is up today. So could we see the dollar continue down, which might hurt stocks in the short run, but could we see those things work like foreign stocks, like oil, like commodities? And the answer is yeah, because generally when the dollar has fallen like it has today, it generally continues for a while. Let's take a look at the VIX real quick, and you can see a little spiky on that, right? This is probably one of the bigger gains we've seen in the VIX. It's up 19% today, probably the biggest gain we've seen since back here during that August time frame when we had that big old 15% drop in the stock market. So, we're getting spiky on that. I would say, though, that, perhaps you see a down open tomorrow and then a reversal. You got 3 days in a row. Let's switch over to the S&P. 3 days in a row. You could have 3 days in a row of a down. Now let's look at this picture here because I've got these distinct lines. I think, we kind of had this double bottom which coincided, back over here. We had to obviously broke through in October, but we went down here, down there. So somewhere in this area, not to get too exact with this, but this is kind of the bad area down here, right? And we spent some time down there. And then what's happened is you went up to a new level. So remember, it broke through here, which this was old support, broke through, came back up and faded, came back up and faded for a couple of days. And once it broke through, now all of a sudden this is your new line in the sand. That's support. So could we come back down here and hit it one more time and then head back up? Absolutely. If we break through, now we're back down in this little penalty box down here, and obviously the selling could intensify. But today feels like more forced selling because there are some things up, as we mentioned. And so today's feels like forced selling because of this carry trade of selling euro, selling yen, and buying stocks. Now you have to buy euro, buy yen, cover that, and sell stocks. So again, I don't think we're setting up for a new trend here just yet. I think we still have, a positive bias to the stock market through the rest of the year. I haven't been happy with having said that, I haven't been happy with the rally from here to here. The quality of the rally hasn't been great, okay? Now, I will say that one good thing that we've seen here recently, up until today, is the Russell 2000 had been doing pretty well, but it's still, when you look back at its peak in July compared to where it is now, we haven't had that recovery. So the quality of the rally hasn't been great. This is still down in kind of the penalty box, right? We really would like, that to get back up in this range, back where it was before, not stuck down in this range down here. So overall, I think you're seeing the market really move down primarily because nothing's been going on. Yes, the stock market is not happy about rates rising, but seems to be a little more okay with it now than perhaps 6 or 9 months ago or a year ago. But I think today is all about this dollar. I mean, obviously that's what it's about. And it's causing these little dislocations. And anytime there's a big move in something, whether it's a currency or whatever, you're going to get this domino effect all the way down. And that's what we're seeing. So, overall, I would, for your more aggressive money, look to add to positions that good quality companies that you want to own. In terms of what do you do with the overall market, is the trend changing? I would say not yet, and be careful about, the last time we had this big a move, we had a drop here in the middle of November of about 4%, 4.5%. So if you count yesterday and today, it's down about 2.7%. So we still could see it fall and not have a change in trend. Okay, we're still moving sideways right now, and not one day makes a market. Remember the Friday of the Paris attacks, and the market actually opened up that Monday? Remember the Paris attacks were on a Friday evening in the U.S. We got that news. Everybody thought the market would plummet on Monday because it was ISIS, and it didn't. The market actually had a really strong day, which was surprising to many. That was this day right here, November 16th, and the market went up about, I think it was over 1% that day, maybe 2% that day. It was a big up day. And so, but now that it's on our homeland, is that why the stock market's selling off? I don't think so. I don't think that helps to have what I think is another terrorist attack. Maybe there's certain people in the administration that don't want to call it a terrorist attack, what we saw in California, but that stuff is a terrorist attack. It's on our homeland, and it's another example of that, frankly, we need to have people be on the lookout and not be worried about being politically correct that they don't want to tell on their neighbors because they're worried what their neighbors might think. If you see something suspicious, you tell somebody, right? And we all know that, but nobody's doing it apparently. So, but I think it does negatively affect the market. But the news of the day is more about, okay, stock market's had this run, we got a little pullback, and when you have this big of a move in a currency, and remember the stock market's been pretty much going up with the U.S. dollar going up. Now that you're seeing the U.S. dollar go down, all of a sudden, stocks are reversing. But I think if the U.S. dollar continued to fall, and we'll go back to UUP here, if this continued to fall, I don't think the stock market would suffer longer term because of that. But I do think the gold, the international, the oil, those things could benefit quite a bit if that continued. So I think actually the U.S. dollar stabilizing would be good, but if it had a little weaker bias to it, I don't think that would be a negative for the stock market. So we do have the Janet Yellen speaking, that never helps, and we got the Fed rate decision coming up. So again, does a quarter point matter? Probably not. But and what does the market do if they don't raise rates? I've said that I didn't think they were going to do it this year. I'll stand by that until I'm wrong. And I think they should have raised rates, and I think a lot of people are fearful that if they don't do it right now, they're going to get behind the curve again, as they typically seem to be all the time. So that's all I've got right now, but we had some big moves, so I wanted to get that out to you and just let you know kind of what we're looking at. I do think you need to, again, have a plan, okay? And one day of markets being down, or 2 days even, is not, what do we do? Because you can get really chewed up in this market right now, even given this sideways choppy pattern we've been in. You take this August, September was nasty enough, but even the whipsaw of being out in September, all of a sudden to see this big rally in October. So be careful about that. So don't over trade. I would look for companies that are weak. And also, I think there's some companies to make investments in. And again, I think from a longer term perspective, I think energy is really, energy and international are very interesting from a long term perspective. And again, keep it in moderation. We're not talking about a huge portion, but I think if you're going to buy something and put it on the shelf for the next few years, I think there's some really interesting areas out there, including those two. Hey, don't forget, every weekend we do our radio show. Airs in San Antonio and the surrounding areas on AM 930. It comes on at 9 a.m. and you can stream it on our website there, and you can listen to archives, eggerscapital.com, EGGERSS capital.com, and obviously we're on Twitter, Facebook, all that stuff. So thank you guys for joining us. Appreciate it, and we will talk to you next time.